Good day. Today we're going to discuss on lecture 10, cash flow identification. Pro forma analysis allow us to focus on the issue or questions and what will be the project impact on the firm total cash flow. So that's why we need to do planning here. So pro forma analysis is vital in order for us to determine whether it is a good project or not to invest. So without doing the analysis, and you may not know what is your return and how fast your return will be, your payback period, your return on investment. So process of estimate expected cash flow of the project when you need the cash, because in the project period, some month you may need more cash, certain month you may least, no need that much cash. So use of relevant parts of this balance sheet and income statements information, then you plan out the pro forma analysis. So in all the part of the financial statement that did not change whether the project is accepted or rejected. Cash flow estimation. As we know, cash is very important for organization. So estimate a correct cash flow is very important to all the organization. A lot of times organization fail because of the cash flow, not because of their business is not success. Sometimes the business is success, but due to they don't know or they misinterpret the cash flow movement, the company will be suffering from cash flow issue. So all these incremental cash flow must be considered when calculate the project expectation cash flow. So the increment cash flow are those cash flow directly attribute to the adoption of new project. Uh, in other words, means when you have these new projects, you need extra money to run the project. Terminologies, component to consider. First, that is what we call the opportunity cost. Whether you invest in A, you will let go B, or you invest in project B, you will let go project A. So that is the opportunity cost. For example, maybe your opportunity cost to go to watch movie will be uh, you need to skip uh, another gathering maybe with your friends. So these are opportunity costs, okay? Or you take up the A jobs, you will miss the B jobs. So these are the opportunity costs. Substitutionary, whether the effect is substitute or complementary effect. So examples, we say tire a car need tires, so they are complementary each others. Okay, but another brand of the car may be competitors. They can substitute. For example, I want to buy yeah, a car. Maybe I can buy different brand. So they can substitute. Yeah, for me. Or now a day, petrol car and EV car, they become a substitute. I buy petrol car, I won't buy EV. I buy EV car, I won't buy petrol car. So these are the substitute. And depreciation, of course, all the things that you need to depreciate, the cost, okay, especially your asset, you need to depreciate. Then your financial costs, okay, you need to exclude all the financial costs. And also need to exclude the sunk cost. Sunk cost means whether you do it or not do it, is there already. So the cost is there. For example, your capacity of your machine, you use 70% of the capacity. The balance 30% of the capacity you did not use, it becomes sunk cost. So that's why uh, company, they try to maximize their uh, factories machine time. They try to fully utilize the machine time. If can get another project to substitute that 30% of the machine time, then will be extra income for the company. Opportunity cost. Yeah, now we are going to detail on opportunity cost. So an opportunity cost definition is the opportunity cost is the dollar cost of foregoing opportunity. For example, I want to go to eat in restaurant A, let's say nasi kandar. My opportunity cost is maybe I cannot go to restaurant B that eat maybe a fried kway teow, char kway teow. So now I got this. If I eat char kway teow, I cannot eat nasi kandar. So this is my opportunity cost. Okay, so in business, they always got opportunity, but all the opportunity come with the cost also. So you need to do evaluation. Like example, in futures, you become the managers. You need to choose project A or project B. What are the opportunity costs involved if you choose project A, not choosing project B? So in later chapter, we will teach you how to count in dollar and cent. Okay, now we just explain the theory for you first. So remember, opportunity cost. Yeah, this is the opportunity cost. For example, new project should be changed for an asset use as well as a wages and benefit to pay to employee working on the new project. Yeah. So when you analyze a new project, this is new project, but you need to know if you allocate the resources to project A, you will miss out the resources to allocate to project B because company resources always limited. Okay, resources can be money, can be people. Okay, they say you only have 10 staff. If you allocate the 10 staff to project A, you may have no enough staff to project B already. You cannot go for project B. So you only choose project A or project B. If you go 10% to project B, you cannot go project A. So this is what we call the opportunity cost. Number two, substitutionary and complementary effect. Substitute, from the words, substitute means replace lah. Okay, replace. So some new product or service reduce or increase the sales cost or the necessary the asset forever uh, maybe already existing product. For example, let's say I'm manufacturing food and beverage. So my food and beverage, if I add one new product and the product is also in the food and beverage, then it become my complementary. Okay, if now I'm selling food and beverage, it can be substitute each other. Okay, for example, I drink coffee and tea, so this is substitute. Either I drink coffee or I drink tea. Okay, substitute. If I drink tea, I did not drink coffee. I drink coffee, I did not drink tea. So this is substitute. Then what it means like complementary? Complementary is like this. For example, two products, they can work together. For example, what are the two products that work together? Handphone and your cover screen protector. They work together. And the more handphone you sell, the screen protector, you also sell more. Okay, tire and the car. The more you sell the car, the more you need the tire. So they are complementary. Okay, so This change to the cash flow also. Yeah, if you complementary, then yeah, it will affect also uh, the project incremental to the new project. Therefore, they should be included in the new project consideration between the cash flow. Of course, substitute one will be yeah uh, more easy, okay, to identify lah. Either you are substitute, okay, let's say tea or coffee, you only can choose one. Complementary, both also you can. Yeah, so that is the beauty of the project. Okay, third thing that you need to consider is non-cash flow depreciation. In a accounting income statement or cost depreciations, we need to include this because all the machines that you use, it can be due to usage. You need to depreciate. The machine become old already. Maybe technology also. Okay, that's why you need to be depreciate. So cost and reflect the deduction in the value of an asset, time to maybe wear and tear. Okay, not an actual payment. You did not involve actual payment. Okay, but you do in accounting depreciation. However, the income tax compute after the depreciation cost is deducted. Tax are the cash flow that is impacted by the depreciation. Put depreciation in our cash flow analysis to compute tax purposes lah. Then take it out. Okay, so we need to have these portions, depreciation. Okay. Number 4, stock dividend and bond interest. So for the projects, you need to finance your projects. Where is the money came from? Either you take from the stock, you issue share, you collect money and invest in the project, or you issue bond. You need to pay the interest, the coupon. Okay, so financing costs are never count as expenses of the projects. So financial costs include interest payment to debt, bond, dividend payment to shareholders. Uh, so you may ask me why not? Because this cost is capital are already incurred as a total company expenses, not in a small portion on your project. So component cost in the WACC that will be used to count this cash flow. So if you include them, you will be double counting. In other words, you are double counting. Okay, so because the company already take one-time considerations for the total project cost. So for your special projects that you excluding this portion. Okay, sunk cost. Sunk cost is a cost that already being incurred and cannot be removed or recover. Okay, should never be count in the project cash flow also. So don't count the sunk cost in the project cash flow. Does not meet the definition of being incremental if the expenses must be paid regardless of your decision. Means, like example, your rental. Yeah, your rentals you need to cover whether they already uh, pay in the normal rental. So you in the project you cannot count. Okay, now we look at initial cash flow, how we draw the timeline. So this is examples that showing to you how we draw the timeline. Start from year 0, for example, to year 3. This is a considered as a 3 years project. So initial cash flow, we name it as year 0. So what it means by initial? Initial is the starting point. So normally we purchase the new equipment. So you need to include the purchasing cost for the equipment, and sometimes equipment that you buy, for example, machine, you may need to install it, and also you may need training. Okay, so all the cost for initial uh, setup or installation, training cost, you can add into this initial cash flow. That's year zero. Sometimes you may able to trade in your new machine with the old machine. Yeah, you trade in. So the old machine selling off, the cost also you can deduct from your purchasing new equipment cost. And also tax implications also, you can add in also whatever tax incur. Okay, then calculate the change in the working capital. So at the end, you just put the, after you do all the accounting calculation, you just put the end figure into the initial year zero. Operating cash flow year, that is start from year 1, year 2, year 3. So operating cash flow during the year, you can count what are the revenue that is the inflow for the year, and also you can count what are the costs incur, then what are the tax that you should pay, then you put in the net figures into it, changing in the working capital. The net figure only you put in year 1, year 2, or year 3. Okay, last part is come to the last year of your project. Normally we put the salvage value in the last year project. So what is mean by salvage? That's also, we call it determined value for last year. Sales of the equipment, after that you sell off the whatever equipments that you have. Okay, then you also incur the tax, then you put the net figure changing working capital into the year 3, and also any others considerations, expenses or whatever, then you get the net figure, you put it there. So when we talk about projects, normally you need to count this after tax salvage lah. Yeah, for example, if the salvage value is different from the book value of the asset, then that is a tax effect. For example, book value, yeah, uh, book value equals to initial cost minus the accumulated depreciation. For example, maybe you buy the machine, initial cost, you buy the machine is 5 million, but after the machine already used for 3 years and is considered depreciate. Let's say you depreciate already, accumulate almost 80% already depreciate out. Okay, so the balance is only 20%. So after tax sandwich is, the sandwich is 20% left over. Let's say you bought it, your machine just now, we say you bought it to make it more, yeah, uh, clear. So just now you bought it 5 million, you accumulate depreciation about 4 million, 80% 4 million, so left out only 1 million. Okay, so sandwich value 1 million, so 1 million plus the tax, so book value minus the sandwich value. Okay, then you calculate the market value. The sandwich values, yeah, equals to market value. So normally the government will want to tax based on the ATS, market value plus the tax time the book value minus the market value lah. So in this case, they say the market value is 2 million, the machine, so you need to pay tax, tax time the book value, you left 1 million, but market value is 2 million, so you still got to pay some tax. So these are the calculations. So here I give you some examples for you to try. Let's say the depreciations you calculate for 5 years. So average 22 years per 22,000 per year. So book value 5 year is, let's say, 110,000 minus 5 times 22 equals to 0. So after tax, market value plus tax time book value minus market value. So market value, let's say, is only 17,000. Okay, so you plus 0.1 is the tax, let's say 21% tax rate. Okay, 0 minus 17, you get about 13.4. So this is the answer. So total project cash flow. So free cash flow, as we discussed just now, yeah, is used as a measure of the total amount of available cash flow for the project. So different from calculations, uh, free cash flow number will be estimate. FCF will be calculated on the potential project individual rather than across the firm as a whole. So total cash flow calculations, this is a total cash flow calculation, but don't worry, there is no questions that on this calculation. So this is also example how to calculate the depreciation, just for information only. Also, no questions will we going to ask you on calculations. Of course, you need to know a little bit also on how people calculate the depreciations. In accounting courses, we also learn how to do calculate the depreciations. So here I will not repeat anything here, just for the calculation of depreciation. But you need to know a little bit for your knowledge, general knowledge. Uh, this is the US system IRS publication 946, define the depreciation basic based on cost, based on amount paid for the item, based on the freight charges, installation and testing field. So two type of depreciation method, straight line and MACRS. So you will learn it in accounting, these two method. Here we just do a revision, touch and go. Okay, first method what we call the straight line depreciation. As you can see, annual depreciation for each year will be equals to the depreciation basic minus the project ending book value over the number of years. So this is very simple, straightforward. That's why they call it straight line depreciation. Half year conventions, IRS request depreciation calculate using half-year conventions. So they can use half-year convention estimate saying property placement in service during a given period is assumed to be placed in the service on the midpoint of that period. So this is follow the IRS classifications on the asset life. So straight lines depreciation with half-year conventions. For example, they came out the table for you so that you easy to count. See? If uh, if your project is, let's say, yeah, based on normal recovering period, if let's say 2.5, then 20%. Okay, if 3, then these are the percentage. If 5, then these are the percentage. See? Every year you need to deduct how many percent here. So this is accounting. They need to prepare the account. They need to refer to the table here. Another method is what we call the MACRS, depreciation calculation. So this is also a method that you learn it in accounting. So for these parts, we don't have any questions in exam. You just need to know we have what we call the MACRS depreciation calculations. Okay, so ascending depreciation allowed the firm to expand more of an asset cost earlier in the asset life. Means, for example, they buy the machine is 100,000, so the first year they can deduct 50% of the asset as a depreciation, then followed by 50, 30, 20. So 3 years they finish depreciate all the asset. So they start with big amount. Another one is a double declining balance method, result in a double the depreciation rate used in the straight line method. Okay, so based on the straight line method, yeah, they calculate the times 2 lah. So this is another way to calculate. So this is another tables that you show it. Yeah, of course, when you prepare the accounting, then you need to refer to the table and prepare it based on what system you need to declare, what system you use for calculate the depreciations. So this is another method to calculate the depreciation. So bonus depreciation and section 179 deductions. So these are talking about the bonus depreciation. Tax cut and Job Act. These are all follow the US regulations. Yeah? So that is also not in the exams. Okay, exam questions. Normally, exam question like to ask you to calculate operating cash flow. So, how to calculate the operating cash flow? You refer to the formula below. EBIT. A lot of you learn the EBIT already. In your assignment, I explain to you earning before interest and tax. This is called EBIT times bracket 1 minus tax rate plus depreciation. So a lot of you did a very good job in your assignments when you uh, do to calculate the ratio. So when we calculating the operating cash flow, remember method 1, we are using the net income approach. Net income approach is the most uh, simple one. So straight away, refer to the formulas here. These are the method. OCF equals to EBIT minus the tax plus depreciation. Straightforward. Method 2, that is what we call the calculating operating cash flow. So method 2, calculating operating cash flow, we are using the bottom up approach. That is OCF equals to net income plus depreciation. Okay, so net income plus depreciation work only when there is no interest expenses. So some of you, you do your projects, you do asking me on that methods on calculations. Okay, step 3 that okay, method 3, top down approach from the sales minus the cost minus the tax. This is top down approach. So method 1, method 2, method 3 also can be applied. Depend on the questions, whether the questions giving you what are the things that they give it to you so that you apply method 1 or method 2 or method 3. Method 4, that is tax, yeah, and minus the shell approach, OCF sales minus the cost, okay, bracket 1 minus T plus depreciation times the tax. This is another approach that you can calculate the operating cash flow. Uh, this approach view the OCF consists of the two components. There is one, project cash flow with no depreciation expenses, depreciation deduction multiplied by the tax rate only. Okay, this slide showing you the method that just now I explained to you, method 1, method 2, method 3, method 4 in the graph form where to deduct, okay, uh, step by step. They teach you, these are the accounting presentations. Okay, all of you are familiar with this presentation. Only one presentations, okay, but you need to memorize the step lah, how to do it. Method 1, method 2, method 3, method 4. Okay, another calculation parts for gross fixed asset. Straightforward gross fixed asset, we are using this formula, ATCF, market value minus the book value times the tax. Yeah? So calculating changing in the net working capital, uh, we know business always got business cycle. A company will have to fund the purchase of materials and pay employee, pay rental, pay all the expenses overhead before selling the products and eventually getting paid. Does it need a certain level of cash and other short-term asset to get through the cycle? Yeah, that is called working capital, because whatever from the productions, raw material, you start buying raw materials, then process, all need to pay. Rental need to pay, employee salary need to pay, and also electricity bill need to pay. Everything need to pay until finishing product. After you sell not immediate, you collect back the money. So a lot of business run in term, maybe 1 month, 2 month, 3 month. You give the credit term to your customer, then only you collect back the money. So before you collect back the money, you need some working capital, they call it, some capitals, so that you can do your business. So we report the changes in the level of working capital as at NWC cash flow. So most straightforward is to ensure we need the net working capital. In other words, without net working capital, you cannot run business. Yeah, so that's why that is most complicated versions, that working capital need to be adjusted every year. In fact, some companies are not every year, every month they do it adjustment. Yeah, they do it every month or every quarter they do it adjustment, to safeguard that the company not get into financial crisis lah, or financial problem. So I also prepare you some questions to try to do it. For example, your computer game price is 39.99. Project unit sales, this is the year 1, how many unit, year 2, year 3, how many unit, variable cost, how much, fixed cost, how much, setup cost, how much, everything. Yeah, your game development cost for the new game total, new working capital requirement at beginning of each year will be 10% of the project sales during the coming year. The tax rate is 21%. Okay, processing machine will be depreciated based on the straight line method, 5,000 over lifespan. We expect to be able to sell the machine at the end, 2,000 salvage cost. Okay, the new game will be cut into the sales of an older game currently on the market. So the old game will lose sales of 2,000 per year. Okay, and the old game sell at $19.99 and have variable cost of $3.50 per unit. So these are all the information. Gross sales or variable cost, so we can calculate this way. Net incremental variable cost, we can calculate this way. Of course, don't worry, this is more on accounting. No questions will be asking you on this area. So they present to you the net equivalent cost. Okay, they present to you this. So depreciation, like just now, these are examples, straight line method, how they calculate the depreciation per year. So OCF, how they calculate. Okay, like just now I explained to you already. So you need to calculate this part. So at the end, you present this uh, income statement, pro forma income statement. This is the one that you prepare, but don't worry, exam uh, did not ask you to prepare the this. So exam, it's not include in accounting. This is some sort like preparing the pro forma analysis lah, like accounting. So these are the, at the end of project, we need to count the tax component. So this, you are using this formula to count the tax component. Then these are the tax ATCF. Okay, so in exam, normally questions will ask only this ATCF, not just now one, but this one. Yeah, they will give you everything, market value, tax, everything. Then ask you to count this ATCF. So calculate the net working capitals. So these are the one that, yeah, it will ask you to calculate a very small part of the net working capital. Not ask you to prepare the whole statement. No need to worry. Okay. Okay. So they only count the OCF, FCF, this part. The end of the chapter. Thank you.